Recently, I made a video about Micron technology, and in the comments, I got a very interesting request. Ominolo, and I hope I pronounce it right, wrote, "Please make a video about ZIM." Well, I had no idea what this company was, but when I checked, the first thing that jumped at me was a dividend yield of over 100%. So when you see something like that, a red light flashes and you want to find out what is the catch. Because if something looks too good to be true, it probably is. But maybe not. Maybe it is a truly great opportunity. So today we will try to find out, is ZIM a great investment or a trap? But first, what is ZIM? It was founded in Israel in 1945 and is a global shipping company with a fleet of different vessels, including containers, dry bulk, and crude oil ships. It operates in approximately 100 countries with a fleet of 149 ships. What is very important is that container freight rates dramatically increased over the past several years, making ZIM extremely profitable. In March 2021, ZIM reported the biggest profit in its 75-year history. So let's see who invests in ZIM right now. Insider ownership. That's an X, and it is only Eliyahu Glickman, the president and CEO, who owns the shares, and it is 1.3% of all shares outstanding. Now, insider buying, that's an X. Insiders are not buying. And super investors, that's an X as well. No super investor has put his money into ZIM. And super investors buying, that's also an X. So as we can see, we have our first red flag. But why is that? Why aren't investors interested in this company? Well, the main reason is that a drop in shipping rates is possible if a global recession occurs. And it seems very likely at the present moment. And trade is obviously lower during a recession. So with falling demand for goods, ZIM could suffer financial losses. So it seems that investors believe that the recession is coming and that it will hit companies like ZIM the hardest. So now let's take a look at the financial health of this company. Return on invested capital. That's a check, and it's 77%. But we have to remember that we have data only for the last 5 years. And what about free cash flow growth? That's a check, and it's 122%. But as with return on invested capital, we have data only for the last 5 years. Okay, and what about profit margin? That's a check. The profit margin is 45.1%, and this is net income margin. So this is really, really good. And what about shares buyback? That's an X. They issued 19% more shares in the last 5 years. So this is something to remember if we want to invest in this company, because we are getting diluted as investors. Okay, and what about the debt? That's a check. It would take less than a year with a current free cash flow to pay the total debt for ZIM. Now, let's take a look at the dividend. The dividend yield, that's a check. It is 108%, which is absolutely crazy. And what about the payout ratio? That's an X. It is 52.5% of their net income. And what we are looking for is a payout ratio of 30% to 50%. So we are pretty close. And in their recent results, they wrote that they intend to keep the dividend between 30 and 50% of their net income. So that is a very, very positive news. And what about dividend growth? That's an X, because it is just too early to tell. The first dividend was paid at the end of 2021, so we just don't know where it will go from here. Okay, so we know a bit about the investors, the financial health and dividends, and now it's time to value this company using a discounted cash flow formula. So for this valuation, I will use a 5-year average free cash flow and not the recent one, which is extremely high. And because recession is very likely, the growth estimates will also be extremely conservative. In the low scenario, the estimated growth will be minus 15% for the first 5 years and minus 10% for another 5 years. In the medium scenario, minus 5% for the year 1 to 5 and then minus 5% for years 6 till 10. And in the high scenario, we can estimate that the company will have no growth at all. So, what is the intrinsic value? For the low scenario, it is $45.6. For the medium scenario, $82, and for the high scenario, $118.79. But of course, these are not the prices we should buy this company for, because we always need a margin of safety. I use a 30% one. And with a margin of safety, the prices that should interest us should be around $32 in the low scenario, $57 in the medium, and approximately $83 in the high scenario. And the current price is $24.93. So even with such a strong negative growth for the next 10 years, it seems like a good investment. But as always, we have the data from the past on one hand and a story in which we believe on the other. And it seems the investors believe that this investment can be very dangerous at a present time, which is why the price is falling. On the other hand, we have great financial results for the last few years and a solid balance sheet, and on top of that, an impressive dividend. And all of that at a very interesting price. So let me know in the comments below, what do you think about ZIM? Do you think it is too risky to invest in a shipping company during financial crisis? Or is it a golden opportunity? And please remember that before making any financial decision, you should always do your own due diligence. Okay, thank you very much. I hope you enjoyed this video, and if so, then please like it and subscribe to the channel if you want to see more videos like this. Bye bye.